Let's continue a conversation right here with Wolfe Research, Peter Supino. Peter, tomorrow it all starts over again, so to speak. Disney can move its attention to the future. What, in your opinion, is sort of key for the company as this year unfolds from here without the distraction of a proxy fight?
I like the way you started that conversation, and I appreciated in your video role before this, James Gorman's comment that so much of this proxy battle has been backward-looking, and it is time to look forward. I think this annual meeting drama and this proxy battle is based on real substance, and it's fascinating. But actually, with Disney trading at $123 or now $122, thank you, per share, the stock price is certainly looking forward, and analytically, we should too.
Its stock price is saying what?
Is looking forward. 123 is a generous enough stock price that it's discounting a huge improvement in profitability at Disney, and that really was the primary bone of contention in this proxy fight. And so I am making the case that the stock price has begun to look forward, and it's time for the conversation about Disney too as well.
Right, and so they're going to have to deliver to a certain extent. What is the key thing there? Is it being able to deliver on the promise of profitability, for example, in the direct-to-consumer business?
That's the number one. I mean, the board and the succession issues are important. They're critical. They won't be resolved in the next few months. They shouldn't be resolved in the next few months. The streaming profitability and broadly the media segment profitability debate has been the thing about which you could really not only have a point of view, but demonstrate progress at Disney. And so here are some numbers. In 2022, when Trian first took a position in Disney, Disney's operating profit was negative $3.4 billion in the DTC segment. That number was actually worse or better than the underlying reality of the business, because Disney's cash programming spending, the amount of money it was spending on cash, on content, was running ahead of what was on Disney's income statement. And so really the cash losses were greater. Today, we're forecasting 2026 direct-to-consumer operating profit at over $3 billion. So that's a $6 billion swing. And if you adjust for Hulu's idiosyncrasies, it's about a 14% operating margin going forward, which is an attractive level of profitability. Disney's done a lot of the right things in terms of setting up the outlook.
The backdrop, of course, continues to be the continued decline of the legacy media business, so to speak. I hate to say that, of course, because it includes the likes of what you're hearing right now. What are your forecasts there? The acceleration has only continued in terms of cord cutting when many thought it would sort of start to at least die down. Does it get worse before there's any sort of plateauing?
Prior to this conversation, I was refreshing in our Disney model, and I observed that during the same time period, 2022 through 2026, that I just mentioned, past to forecast, the linear TV business within Disney, the operating profit contribution went from $5 billion back in 22 to prospectively about $2.5 billion. So it's a big headwind to the company's growth. The good news is its contribution looking forward is small enough that we can probably spend our time more productively focused on DTC and theme parks. However, defending that $2.5 billion profit stream is important to the company. And they've made a lot of noise about how ESPN is going to begin its evolution. But there's more uncertainty than clarity on that topic. ESPN will have a really hard time extracting enough revenue from enough households to recreate its linear TV revenue stream.